right, welcome back to another monthly stock purchase. We've been doing our research here. Here's our portfolio, so you can see it on screen now. Things have been looking good, but we wanted to talk about especially a few of the... So we've had several requests, right, for us to look at stocks, but in the end, we only chose a couple of them. So I wanted to first talk about a couple of the awful ones. Let's jump right in here. What were the two that we said, you know what, these are definite no's?
Do we want to be super negative? No.
Let's just be moderately
Let's just be moderately negative. So the two that we looked at, if you look at our spreadsheet, 22?
I don't know anymore.
We're almost 2 years in. So the ones that are crossed out on our spreadsheet are the ones that we looked at them, and for either financial reasons or just bad timing on the quarterly statement when we pulled them in there, we just said, no, not going to do it. But two of them we want to talk about. First one is Altera Group. Stock symbol MO, not stock MO, just MO, stock symbol. To explain why we said no to that, is all you have to really do, very briefly, is just go to the net income on the quarterly statement. It shows up 866%. And if you look at the company and you actually go into their operations, their net revenue, the receivables, it's not coming from that. It's like 20% gain on that. So there's a discrepancy, and usually when that happens, it's just the timing of when we buy the stock to when like the end of the quarter is. So they had a really bad quarter and then they had a decent quarter, and it just inflated the number so much. So because of that, and because it just, you know, they can't afford the 10% dividend, we just said no, we're just not going to do that one.
That was an easy one.
It was an easy one to cover. The one that's a little bit more involved is Disney.
Disney, don't sue us, Disney.
Why'd you say that? But
I feel like we were talking about this beforehand. We were saying, oh man, we're gonna lay into Disney in this one, but go for it.
I got a personal vendetta here because I got a family, I've got young kids. She's like, let's go to Disney World. I'm like, all right, let's go to Disney World. And my jaw hit the floor when I looked at the pricing. The cheapest hotels we could find, the cheapest one, family of four, our 2-year-old son doesn't count, because you know they don't charge them tickets or anything. They might rethink that policy, but it's like $15,000.
See, you're not going to Pop Century though. You gotta go to Pop Century if you want the cheaper hotels.
It was the Pop Century.
Was it?
Yeah, it was the cheapest two we could find was like $10,000. It was a 10-day stay, and it was the food pass, and it was 6 nights in the hotel, and it was still like 14 grand.
Yeah, it's expensive.
It did not include the flight, and it did not include the car. So we said, all right, let's shop around, because the most expensive ones, like the Animal Kingdom, it's like 30 grand. It's like, holy crap. I can either go to Disney World or buy a brand new car with cash.
Right.
Like a nice car. Like, who's going to Disney World like that? That's crazy. So that was part of the investment search. We looked at like condos around the area, and we found we could get it all the way down to just under $9,000. Now that was very conservative on food, but we got like a 3-bedroom condo with its own washer and dryer. We got the flight, we got everything pretty good. So the tickets by themselves for Disney were still pretty expensive, not terrible. It was like $5,000 though.
So the question is, if you're making all this money on people going to the parks and they're inflating the prices, why are they losing so much money?
That's the other problem. They've got this streaming service that they partnered with Hulu, and you know, it looks like they're starting to gain some traction. And the last few quarters look good, right? So they've got if you look at the spreadsheet, they've got 62% that they went up in their net income quarterly. That sounds good, but when you look at the macro picture, the big picture of these guys, and you go back 5 years, it don't look so good. So from this time today, from where they were 5 years ago, they're down 78% on their net income.
Right.
They've got some hurdles to clear. Want to go to the park, I want to spend money there, but I'm not going to spend a new car's worth of money at Disney World. Plus their streaming service has had some issues with some videos bombing. They've got some problems where it's not as profitable as it should be.
Well, their movies aren't hitting either. Right. When you look at the Marvel movies, in the beginning of the Marvel Cinematic Universe, each movie was making $1 billion.
And now it's not even...
They've had like $1 billion movie in the last like 4 or 5 years.
Yeah, and I'm a huge Star Wars, huge Marvel fan.
Don't even go into Star Wars. Go to a Star Wars theory if you want to go to that, but...
If you guys want to make a good movie, I'm a good Jedi. Or evil good. Maybe I'm a
You'd be a Sith.
Sith or something. But
I'm more of a
premise,
gray Jedi.
what I'm understanding here is that it's that they're having this rough patch, but they're also not handling it in a way that seems to be pointing in an upward direction. Is that what you're saying?
Yeah.
Is that like the main issue going on here?
There's a big political struggle going on down in Florida right now, and that could affect them too. I want to like Disney. I want to buy them, just like what we said with Target a few months ago. But there's a lot of headwinds, and I need to see that profitability. We need to see that profitability in a better place.
Right.
The reason why they came up is because of all this news, and you look at their trailing where they were 52 weeks ago to where they are now. They're not on the high end, they're on the low end of the 52-week margin. So we thought, hey, maybe that'd be good. That's the same story with Nike. Nike's down quite a bit this year, but the numbers didn't quite line up with some of the other stocks on this list where it looked like it was in the bargain bin. Like we're shopping in the clearance aisle, like people like
always.
We're trying to find a good bargain, and Disney might be closer next time. We'll put them back on our list in a few months, but between those two companies, we just couldn't justify the purchase, at least not yet.
Yeah, Disney needs to really fix their management of the company. They're mismanaging the company and their assets right now. So
they're going to sue you now.
So once they fix that,
Yeah.
I think they'll be on the right track again.
Yep.
Watch out for the Mickey Mouse ears. Hunting you down later after you said that, Brian. All right, so we had a variety of other ones. There was a couple of these stocks that were maybes that we were considering, and we were saying, okay, maybe we do this. Let's talk. I want to talk about a few of those before we get to what we decided to choose in the end. So I know we had, what was it, Medical Properties Trust, and what was the other one?
Kellanova, General Mills.
Yeah. How about you tell us a bit more about those?
Okay, so Medical Properties Trust, that's an REIT. We've talked about REITs for months. We've been waiting on the Fed to do their thing, and supposedly everybody thinks the Fed's done their thing. They thought they were going to finally lower rates in 2024. Well, the Fed came out and said no.
Well, they did a thing. It's not their thing.
The thing with the economy is with real estate, especially with interest rates and banks, they're tied very closely together. It takes time. It's not like the Fed says, oh, we lowered rates, and immediately companies like Medical Properties Trust and all these other REITs just suddenly randomly their finances look good again.
Right.
It takes time. So we've been looking at CIO and Alley Capital, Medical Properties Trust, a whole bunch of businesses now for months, just waiting to see when that bottom is. Medical Properties Trust, finally, this quarter, we've had them on our spreadsheet a few months now. And so people know when you're looking at the spreadsheet, the crossed out ones are just like a flat no. The ones that don't have any blue on them they look okay. The ones that we might buy them, and the ones that are highlighted are the ones that look really good. So MPW looked good for the reason that they finally showed a net inflow of cash. They've had quarter after quarter of just like bleeding money, and they went from like $20 to $25 a share, paid a huge dividend. I've had them for 8 years. They paid a dividend for like 10% for the whole time. So I've made my money on them, but I've been waiting to see where is the bottom, because everybody's in the real estate market's been bleeding from this interest rate problem. And like real estate's now at the slowest point it's been in 20 years. And I guess the average real estate agent sold 0 to 1 homes in the past year. So that's going to affect these companies. And we want to know when that hits, because when it does, we do not have a real estate company in our portfolio.
Not yet. We've been waiting for 2 years.
We've been waiting. So we think they might be close. That's why they're blue. And when you look at their numbers, you're like, oh my God, what are you guys thinking? They look awful. They look better. It's bad, but they look better than they used to. Do we buy them? No, but we're watching them to see what their next report comes out with. If their next report looks like some cash flow, like the bleeding has stopped, we might buy them. That might be close to the bottom, but until we see that, we're just watching it.
If you guys want to see when we do that, have our own video on REITs at the time, go ahead and comment below.
Right. Hopefully that answers the question.
Yeah, I like it. All right, what
was
about
the question?
Actually, I would add to that, if you want to stay up to date with these stock picks as they go, we have a whole playlist of these you can check out after this. So tell me more about Kellanova now.
Kellanova is it's a food company, and we were thinking, hey, recessionary behavior, Christmas, and so people know there's like dozens and dozens and dozens and dozens of articles that we research and numbers that we go through to even get to this list. So Tyson Foods was one of the ones that we compared against these guys, and there's 2 other ones. We thought that with the recession hitting, we noticed through like Johnson & Johnson and Procter & Gamble have notated in their quarterly reports that consumer spending is changing. So what better way to get in front of that to look at companies that produce products that people, well, quite frankly, can't live without.
Right.
So Kellanova was one of those. They have been, according to the Standards & Poor yield fund, they're down 30% from that. So they looked like they were a bargain stock, and I still think there's some truth to that. But when you saw the drop, you saw the value decline, and you pulled up all the numbers in our spreadsheet, you see that there's some good things, like their assets are up, their liabilities are down, but when you look at their net income quarterly over 5 years, it doesn't look that great. Their cash flow, however, is amazing. So these guys were close. We almost bought them, but they weren't as close as the other ones. So we're going to probably keep this one on our list again in the future to see maybe, was it a good timing thing? Was it a bottom thing? Not sure, but they didn't quite look as good as the other ones. It's still, to me, when I'm looking at the stocks, the reason why they're in blue, the reason why they look like they're positives, because there was a lot to good to speak about them, and they're a very indispensable type of business. There are some headwinds with what's going on, with some of the lawsuits going on there, but we don't really care about that long term. So as far as that, we didn't buy it, but not because we hate the company. There's not a whole lot to rag on with these guys, at least not yet.
Nice. All right. And that brings us to the last two, which is funny because we were discussing this before we were recording here. When we were saying there's not very much to say about these, but we got Chevron and Procter & Gamble.
Yep.
Anything to say on those? Like, why yes this time?
Yeah, there's quite a few things for Chevron and Procter & Gamble, but to be brief, I want to quickly go back to General Mills. They're part of the Kellanova mindscape there. So if anybody looks at that and they go, well, how come they didn't mention General Mills? They're in blue. Well, that's why. They look good, just not as good as these other ones. So the ones that look really good are the ones that did the worst for us last year. Like Chevron is one of our worst performers in the Dividend Dudes portfolio. However, as I was talking to Brian about this last night, their cash flow over 5 years is up 200%. Their net income over the past 5 years is up 140% almost. Everything looks good. Their liabilities are down. Their assets are up. Their net income quarterly is down. Why is it down? Well, they're fighting with California. Like $3 billion. I guess California wants to tax them because they're an evil oil producing corporation that's polluting the environment and killing our children actively. I don't know. So they're moving their corporate office from California to Texas. They're still going to have a presence in California, but there is an impact there.
Now, one thing I want to note about cash flow, when you look at that, you have to really investigate where that cash flow is coming from, because it could just be coming from external sources. But if it's coming from their operating, go look at their operating income, and that's where it's coming from, then you've got a pretty good source. Anything other than that, you really got to dig. You really got to dig deeper to find out where that money's coming from.
Dig deep, Brian.
Dig deep.
Dig deep. So what he's talking about is the net income number, that 140%. That is, even though they're down over the past 5 quarters, they're still, from where they were 5 years ago, their operations are paying them like double what they were making. That's only 5 years ago. It's not that long. So,
that's a green flag. Is there a green flag? We got red flags.
Green flag.
Is this a green flag?
This is my white flag. There are many like it, but this
works.
one is mine. Wait, that's green. So the other one was Procter & Gamble. If you just look at the spreadsheet, that tells the tale for us. They're a pretty boring company. I mean, they make soap and razors and a whole bunch of other stuff people have to have.
Think 3M and all the other ones.
Yeah, if you're not real sure where the economy is going to go and your portfolio is small, like Dividend Dudes, we got $23,000 invested. We're making $943 a year on that $23,000 invested. We got a cushion of $9,000 of cash to buy more stocks. So, and it's up. The portfolio's made money for us, plus the dividend checks we're getting. If it's small like that, it's good to have very reliable dividends from safe companies that you know that unless an apocalypse happens, you're pretty much guaranteed that you're going to get your income before you buy the risky ones. Procter & Gamble is one of those companies.
Right.
Also, if you pay attention to the economy and you see recession, bull cycles, bear markets, all the things that, it's good, economy is doing great or bad, that affects these companies in a very unusual way. Like you find out during good times, people buy expensive shampoo or expensive soap. During bad times, they buy the cheap stuff. And right now, people are starting to buy the cheap stuff because, like I was saying, Christmas, 61% of purchases were done on credit cards. It's like a record number now. So with that said, Procter & Gamble, just with everything else, I mean, just look at this. They've got 276% net income over 5 years. Even the quarterly is positive. The total assets went up. Now their liabilities went up, but not as much as their assets. Their cash flow over 5 years, 220%. And even the 52-week high and low, they're not high, they're not low. They're a little bit towards the lower end of the spectrum, but they're looking good as far as a value play. There's not a lot of value plays in the market right now. It's really expensive. The trailing PE of the stock market, you want to get technical, is usually around 18 to 20 times earnings. That means if you give somebody $1, it takes them $20 to make that money back to give you the dollar back. Right now, it's like 26 to 28. It's really high. So finding a good bargain is not easy right now. So we thought we found a good bargain in Procter & Gamble. At least that's what we think.
And going on what Tom says, if you are just starting out and you want some safe, you have to have the safe Procter & Gamble's to give you income in order to be able to do the more riskier plays. Your defensive mode is pretty wide. So if you're wrong on your risky play, it doesn't hurt you as much.
Yeah, and picture this as not making money on the value of the stock going up initially. Picture this as you bought a position in a business that makes a product that you're making a very small percentage in every time they sell a Gillette razor or a Tide laundry soap or one of their products, like some shampoo or something. So that's where your money's going to come from in the short term. In the long term, the stock price will go up and it'll do well that way. But when you buy it, picture it like that and you'll do just fine.
You got it. So stay up to date, subscribe. If you're in a place where you are looking to educate yourself more, we're doing these every month, just keeping you up to date on what we're doing. So we'll see you in the next video.
Thanks for watching.
Thank you.